On the daily S&P 500, after hitting this key support a couple of times, we're finally in a bearish scenario with taking short trades only. So on the daily S&P 500, as I said on the price chart here on the daily, it's hit this key support at 69.10. Second time, it's actually broken down through the moving average of the price chart. And that's also a result of this bearish divergence we had on the CCI 150, lower highs on the CCI versus equal top on the price chart. That's actually broken down. Now, still potentially further downside to go. And we look here on the 1 hour chart. What we're looking for is any potential divergence. You can see here we had a double bottom on the CCI, and that's considered a bullish divergence. Same period on the price chart. Lower lows on the price chart, equal lows on the CCI, and that's actually broken up. Now, if we drew a Fibonacci on that one, also very likely it's hit broken through that 23-38% range. That's a minimum retrace we can expect. It's already done that, and you can see that it's pulled back into that towards that 23% range. We don't trade these divergences. We look at them as a potential area to get out of short trades if you're going short during this period. So that divergence seems to have played out. And what we look at here on the 1 hour chart, if you're trading long during this period on the daily, you would have taken these long trades on the 1 hour. And again, the way you trade that is you take long trades when the moving average of the price is in an uptrend. You pay attention to the CCI. You can see there we had a bearish divergence. I haven't marked the lines, but just by eyeballing it, you can see there lower highs on the CCI to that point versus the same period, higher highs on the price. Bearish divergence, and eventually it pulled back. Then it started to recover, and you would have closed out your first trades on that downtrend of the moving averages and started long trades again from that period, then closing it out again there. And that way you would have avoided that drawdown, and you would have taken the last long trade in that little period until finally taking short trades from that point, as indicated here by the the daily chart. So looking at the short positioning, going short only. Again, when the moving average is in a downtrend, paying attention to any divergence, and you can see there, follow it, closing it out when that moving average is turning up, and noticing that at that point the CCI is moving in tangent with the price, and finally we had a new low down there on the price, but an equal bottom on the CCI, and at that point you would have closed it out once that broke through and it turned up there as well. And that way you would have had a couple of short positions entered and a couple of profitable short positions entered. So for the NASDAQ, similarly, but not exactly the same, you've got lower highs on the price on the daily, the resistance there at 26,120 and that lower high there. So it's not a bearish divergence, but again, we still follow the CCI and see where it's trending. At the moment, we would have started taking short trades from about the 13th or 14th of December. CCI was already below its moving averages, and you would have taken those short trades. And I'll show you the short positions in the back test in a moment. But looking at the long positions first from that point, from the 27th of November, that's indicated here by the hourly chart. Again, same sort of pattern. You would have taken long trades with the moving averages in an uptrend, paying attention to any down potential on the CCI, which it was. Bearish divergence there. Again, I haven't marked it, but you can see there just by eyeballing it, you've got a higher highs on the price, lower highs on the CCI. That was a bearish divergence, and eventually it broke down. Taking long trades again, closing it out. Long trades, closing it out, and avoid going long during that period. And that way you would have avoided these drawdowns. And on the short positioning, then going short from about the 13th of December, a couple of average downs with those two short positions taken on when the price is declining. Again, pay attention also to the CCI here. We've got lower lows on the price versus higher lows on the CCI. That's a bullish divergence. And what we can expect here on the 1 hour chart, if we drew a Fibonacci from that low, go back to that high, you can see there it's already broken through that particular 23-38% range very easily. It's currently pulled back into that 23-38% mid-range, and it looks like it's consolidating, and from there it could go either way. So we always wait for that to complete before starting to trade again. But again, always trading in the direction of the daily chart. Like here's some share trading IDs. There's some of the trades we've completed so far in December, and they've returned 4.96% since the start of December this year. So to get access to that bullish share scan, we publish a bullish share scan report each weekend. They can be accessed through the Patreon page, links in the description below. Thanks for watching. Hit that like and subscribe, and I'll see you in our next update.